S corporation treatment or C corp treatment. So another thing that you said, I may need you to repeat your question later, but I kind of got sidetracked with a part of your question. When it comes to S corporations, you almost never want to put a rental into an S corporation because you lose the ability to write off losses the way that you could if it wasn't. All right. Now, an S corp would be a good idea if you have a profitable business that's producing active income, like rehabbing and wholesaling. That will limit that amount, that self-employment tax that you would have to pay. Great strategy for that. In fact, if you're making up $100,000 a year and you're still and you're still following a Schedule C, you are literally paying the IRS
That's good for
way more in tax than you should.
Okay, that's good. That's good. So it's best to do a S corp if you, let's say, making over 100,000 doing fix and flipping or wholesale.
100,000, yes. Now, I do want to give this disclaimer.
I was ready for you to bring it up because it is recorded. So
yeah. So I'm giving you like just broad examples. There could be a whole lot of other things that could affect the entire situation to where that may not be the best outcome, but just generally speaking,
It's something to look at.
if I just had one business that was doing fix and flips and wholesales, and I made more than $100,000, 9 times out of 10, an S corp is going to be your best bet.
But always CYA, folks. Consult your attorney, your accountant.
Yeah.
And just as a side note, what I do when I'm getting a property under contract, because it can vary by state on the preferred entity to hold properties. I'll put it in my name, let's say Juan Pablo and or Sanz. And then once I have it under contract and I'm interested in moving forward, then I reach out to my attorney and say, hey, what's the best entity for this deal?
Mm-hmm.
And then I assign that contract out of my name into the entity you just formed. So I normally incorporate entities after I get the property under contract. Because most people want to say, oh, I want to start an LLC right now. No, I normally wait until after I get a property. So like, you want to find a deal first.
Exactly. And I'm sure you can speak on this way more than I can, but it's hard to get financing for deals that are already inside of an LLC. What most people do is they acquire it in their personal name and then transfer it over.
I actually had an experience because just getting started. It was my second property, single family house. I bought it cash. It was a beat up house, ugly. I call it the Leaning Tower of Pittsburgh. The property's like this. It's like a gangster lien on the property, right? Foundational issues, right? So I bought it wrong. Still got it, cash flowing, but it was a learning lesson. So I bought the property in an LLC. I didn't know any better. And then I tried going to my bank. They said, well, we can't do it. It's a residential property. You have to put it in your name. So I said, okay. So I talked to an attorney to quit claim it from the LLC into my personal name, Juan Pablo, and I had to pay a transfer tax and attorney fees. So I ended up spending, I think it was around $4,000, just so I can put in my name and do a cash out refinance. So that if I would have just bought it in my name just to begin with and have high insurance, that's what I use to mitigate my risk, is having high assurance, like an umbrella policy, just in case someone wants to sue me. I got insurance to cover it. But I wish I would have done that before. I would have saved, a couple stacks.
Yeah. Well, I'm sure that's a lesson.
But that's how it is in business, right? You just learn as you go along. Yeah.
As long as you don't make the same mistake twice, you're good to go.
Right.
Yeah, paid you back.
Right.
That just saved a lot of people a lot of money. You saying that?
Yeah.
Yeah.
So if I save y'all some money, y'all can send me the check later.
That in the book.
Oh yeah, at least buy the book.
Yeah, but S corporations, when it comes, let's talk about entity selection for a while. When you're putting a plan together for your taxes, we're talking about real estate, but what happens if you have a spouse that does something completely different, or you have more than one business that's not just real estate related. You want to take everything into consideration before you make a decision about what entity you want to be in. But the main things I need you to understand is you want to divide your passive income from your active income. That is absolutely crucial. They're treated completely differently, all right? That's another topic I want to talk about, but I think it's going to be hard for me to explain without some visuals, but we're going to try to work through it anyway. Is that okay?
Yeah.
One big topic amongst real estate professionals and landlords is the status of real estate professional from an IRS point of view. All right. So before we get into that definition, I want to give you some basic rules on how the IRS treats different income. All right. So rental income is passive income. All right. Earlier I stated that one of the benefits of being a landlord is the ability to have a paper gain, but actually show a tax loss. There's a lot of situations where you have a paper loss and a tax loss. Maybe your plan is more long term to where you're maybe planning on cash flowing years in the line, or maybe selling when appreciation grows. But either way, rental properties often produce loss, whether it's an actual loss or not.
Loss
All
of
right?
paper,
Well, yeah, loss of paper.
but
So-
not in regard to cash flow.
Second?
Not cash flow losses, but paper losses.
Yes, exactly. So let's set up the stage just so we can all be on the same page, all right? So in this situation, you have rental losses, all right? And let's just say it's an actual paper loss, like you didn't cash flow, and you got a big loss because that depreciation also came in and helped you to increase your losses. The general rule says that only passive income can offset passive losses. So what that means is, if you have let's say $10,000 in passive loss, but you have no other forms of passive income, that loss gets carried forward into future years when you have more passive income. That makes sense? All right. Now there are some special rules around this. All right. Like maybe we shouldn't get into this.
You're like sitting there, I'm like,
I was like, cool. He said there's some special circumstances.
I mean, but one of the special circumstances is if you make less than $100,000 and you can write off $25,000 in rental loss without having to worry about other passive income. But if you make more than $100,000, you want to qualify as what's called a real estate professional, because that allows you to write off all of your passive losses against active income. Yeah.
That's nice.
That is nice.
All right. And so what that looks like is this.
That's crazy.
what, real estate professional?
Yeah.
They have that classification. My mentor, Dwayne, in New York, he's that's how he files his taxes as a real estate professional.
Mm-hmm.
And you can write off all your passive losses on your active income.
Yes. But you have to meet that definition. I'm going to give you guys a pro tip, all right? I normally get this information out in paid sessions, but
And also, Vinny, you can share. I understand you showed the pros, but what's the cons of being a real estate professional as well?
the cons of being a real estate professional is, well, one, you actually have to qualify for it, but I believe that the only con I can think of off the top of my head is, this is going to get even more technical, so bear with me. More than likely, you'll have more than one rental property, okay? And you'll have to make a special election to group those properties, all right? Because each rental property is treated like a separate event.
Now, I just want to make sure, is a real estate professional the same thing as qualifying as a full-time real estate investor?
No, this is not the accredited investor definition. It's just something completely different. Well,
It's just like a qualification
exactly,
or status, and when you file your taxes.
exactly. Yeah, I should have the board up. Next time we meet, I'm going to have some.
Next time we have a projector. We have the projector screen, just not a projector device.
Okay, but I'm going to try to explain this the best way I can, and just ask questions, and we'll sort it out that way. Okay. So, person makes more than $100,000 a year. They have a lot of rental losses, and they want to write them off. They want to qualify as a real estate professional. The pro we say is you get to write off basically all of your rental losses against your other income. One of the cons that I'm aware of off the top of my head is that if you elect to group all your properties as one rental activity, any losses that were not taken at that point has to be taken only when that property is sold. So some of your losses may be locked until you actually sell that property. But going forward, if you meet that standard, all current losses will be deductible in that year. All right? And so the rule to be a real estate professional is this. You have to spend more than 50% of your time in real estate, and you have to spend 750 hours in real estate related activities throughout the year. If you're going to prove this, you need a good time tracking system in place. You can even use a calendar, but you want to track your time and and just have proof of what you were doing and how long you did it. If I remember the math correctly, it puts you at around at least 14 hours a week doing real estate related activities.
For 52 weeks.
Yeah, exactly. There's another definition that kind of rides under that called material participation, which says that you have to, there's a bunch of different rules to qualify, but the most common one is you have to spend 500 hours on your real estate activities or on your rental property before it can be considered an active activity. All right, so I just gave you two different definitions that are the same kind of, but are also different. I also talked about how you need to group your properties together as one rental activity. Here's why. If you have one rental, right, in order to meet the material participation test, you have to work 500 hours on that one property. If you have two properties, each property is treated like a separate activity, so you have to spend 500 hours a year on this property and this property. If you have 10 properties, you have to spend 500 hours on each property, which makes no sense at all. But if you elect it all as one activity, now you just need to spend all that time, on your rentals as a whole versus trying to make sure you spend all that time on each property.
Now, when you say one activity, you mean like a blanket mortgage?
Yeah, what do you mean by that, elected as one activity?
Portfolio.
All right, so for meeting the material participation test, right?
Thanks for watching the video. We appreciate your viewership. By the way, guys, make sure you subscribe to 100%finance.com. We have a plethora of tools that can help you succeed financially. We have a report on credit repair, 3 tips on how you can improve your FICO score. We also have a business credit ebook. We have a ton of real estate related documents, from deal analyzers to a mortgage calculator, a whole bunch of resources. You just have to subscribe. And one last thing, don't want to forget, we are offering free live webinars to answer your questions. This is only made available to our website subscribers. So you have to subscribe to 100%finance.com to receive the details as to the date, the time, and the call-in information for the webinars to answer your credit repair, business credit, or business funding needs, as well as your real estate related questions. Thank you guys again for watching, and subscribe.